through sometimes in the government wasn't shut almost right at home, and so that with the steep sell-off, the long term, or how much I'm trading, and really trying to times I've been successful were when I played for smaller regular moves as all of that goes. So that's what we're looking at. Now, going into today, we're going to talk about something called the symmetrical triangle. And the reason I want to talk about this is something I tend to see around the holidays, around lower market volumes. I see these triangles formulate on the screen. And a lot of it is there's just not a lot of trading. The symmetrical triangle is it's typically a digestive move, okay? You will see a symmetrical triangle. Sometimes you'll see them at the tops of moves. This is oftentimes considered a bull pendant or a bull flag. You'll see them at the bottom of moves. This will be seen as a bear pendant or a bear flag. So you do see these around, and they are tradable if you want. If you need small money, they're pretty safe trade as long as you've got the triangle marked. But they do sort of offer some other things and stuff like that. And before I get into that, I want to talk really quick about some of the misconceptions around them. And it's one, and we'll talk about this, is first of all, most of your chart patterns, most of your candlestick patterns, right? They happen relative to the averages or to move the averages, okay? They do not happen typically. The averages they work in tandem, right? You'll get this digestive move that happens where the range in any stock or index tightens up. It plays into a small tight roll, right? And a lot of that is not to a lot of that's to move an average, right? So if you come down, right, and the index falls strongly, okay, it will be way far off its average. Now, it wants to be close to the average. Guys want to accumulate around averages, right? Especially if they're investing or managing large portfolios, they want to invest around these averages. But what they'll do then is they'll hold the thing up in a certain spot in a purpose to bring the average down into price as opposed to bringing price up into the average. And so you need to be able to sort of identify that on any chart when you're trading. Is what's really happening here? Are we exploding up to the average? Is everybody right? Or are they just dragging the average down into it? Which tends to be, it can be bearish or bullish depending on where you're at. If you're up above the 200 and you're sort of extending into the average, they're holding it up here, bringing the average in, building a new level of support, right, at the average. Now, one of the things too about this, and this is where I see a lot of misconceptions from the sort of support and resistance guys who trade strictly support and resistance. They will assume that we were in this spot for support because it's a key price level, and it's not a key price level other than that it let them at the time move the average. And so if you're somebody who's trading support and resistance, and here's the deal, I failed with support and resistance significantly. I to this day, I cannot trade level to level. It's never worked for me one time. I swear to God, I have tried, hold support, always fails. Never profitable support and resistance trading in a it's at the $2 level. And that means it's going to go to the $5 level. That has never worked for me. I traded with Shay over at Humble Trader. She is almost exclusively support and resistance trader. And so I highly recommend you follow her and see what she does, because it's incredible how she does it, but it has never one time worked for me. And so what has worked is understanding where these support levels show up And there is something to be said for sort of the supply and demand zone thing, the travel between those two places. But even then, I still think it's a fickle beast, and I don't think that you're going to be, you know, I mean, a supply zone only looks like a supply zone until you've got a new supply zone. If you watch like Mike Schwartz, who gives you volume profiles on the daily, he gives you multiple times a day, he'll give you the volume profiles, you can see how those move. And they move a lot. And they move all over the place, and you can put naked POCs all over the screen. And so really the support and resistance, supply and demand, that's a hard one. Again, I would love, my broker doesn't do a volume profile. I keep begging them to get it, and if they don't soon, I'm probably going to leave and find some other platform that does, or other broker that does, but that's neither here nor there. So we're going to go ahead and go right to the charts. We're going to jump into it and look at it. Okay, so what I'm going to see is the red X, okay, that's right there. And what the red X is coming into this morning, get this big move up, and then you got this pullback right into here, okay? And then you came right up here and you created this second peak, okay? Now, this at the time created the, our triangle, okay? So you've got your triangle, you got your down leg, or your negative sloping leg, positive sloping leg. Here, let me go get a second. I can't seem to do it here. So you got your positive sloping leg right up here, okay? You've got your negative sloping leg right here, okay? So you're partway through. Now, it's really funny because you look at this thing, and at the point that I drew this, this is all the chart we had. We didn't have anything past this point. We didn't have, okay? So what typically happens with a symmetrical triangle is you will trade within it for a certain period of time. The market is digesting. And if you think that you can look at this symmetrical triangle and decide which way it's going to break up or break down, you are kidding yourself. You have no idea. It is not possible. You get this, and maybe you can see divergences on slow stochastics or something like that that does it, but this whole thing is designed to screw with your head. Now, it's fine if you recognize it and can trade with inside of it. You know, if you're shorting from resistance up here and longing at support down here, right? But this is normally what we tend to see happen, and this is one of the things I also see guys do. I see this in the Weeble comment section a lot. They'll draw just the triangle part, and they won't extend their trends through, okay? They won't establish a concept of follow-through off of their triangle, right? And the reason that is because they expect this to go up, break out of the triangle, and rock it straight up. That rarely happens, okay? Rarely ever happens, right? Now, what you're looking at here is a failed breakout to the upside, okay? This is a failed breakout, and it's not completed yet. The whole move isn't completed, because what you can see that we've moved into is you have this resistance line right through here, okay? Then you have this wedge right here, okay? Now, at the point that you have this, you do not have the whole wedge. You don't have the picture. This is the formation of the wedge. And what you have happen here, move up to resistance, rejection. Grabs a higher low, again comes up, rejects, pulls back. Now, what I want you to see, and this is why we draw the follow-through. Notice how the top of our candle, when we continue, as we're going forward, we're still extending it through. You see, at the point, this is a peak, and at this point, you don't have this next peak yet, or this one. You don't have any of that. You've only got this. So you can extend that right through. Now, the thing that's funny is notice how you get up to support, or up to resistance, you reject at resistance, and then what does it continue to do? It continues to follow that top line down, okay? And somewhere along here, it tries to grab onto this and bounce back up. You can see here where it tried to bounce back up. Now, this is why we extend the top or the bottom one, your positive sloping one, all the way up through. Look at what it tried to do. It came down, retested the back of this wedge, of this triangle. It came up and it tested that trend there too. It rejected and fell away and is now creating itself, setting itself up into another wedge movement higher. Now, this is relatively bullish. This is typically seen as bullish, okay? To what extent? What you will probably get here is a move up higher to fill the gap, the one right there around 386. We'll look at that on the chart later in a minute. And you can see here where I thought, well, okay, this is a possibility this might happen. I came over here, I did buy a 386 call. It only cost $3. It's a bit of a lotto ticket to see if that would happen today. It did not. By the time, I mean, it was only $3. It was either a hit or miss. So it was a lottery ticket for me. So, okay, well, let's go ahead and clean up this screen a little bit. We're going to delete this off of the back. We're going to go ahead and jump over to the daily chart. Okay, and then we're going to turn the Bollinger Bands on and just leave it that. We don't need all the MA right now. We already know where we are relative to the MA. Okay, so going into the daily chart, again, you have this massive sell-off right here. Okay, it is huge. There is no buying through all of this. And what you've basically created is this spot where you have lower low, or higher low, and then coming back over here, you've got yourself now your lower low. But up here, you have a higher high, okay? This is a tough one. And the reason this is tough, and the reason we need our fellow, if you're a bear out there, we need you to take some profit out here and get out of this, is because we need to create a higher high in order to maintain this, or we need this thing down here to embed in oversold. Now, as of right now, you're 2 days in there. Tomorrow morning, there's a chance this could pop out of that. We will see. The morning will tell us. If it does, chances are you will get your move back up into the mean, which is roughly the 18-day moving average. The good news about that is if we do get that, then we will get this gap fill. You'll knock some stuff off of the chart. You may not get this one. You might get this one over here. I think that 18-day will come down a bit. So you'll get the gap fill tomorrow. Good news about that. If you can fade the gap, if you can ride that and capture it, fantastic. But what I will say is pretty good chance of a nice short entry. Now, one of the things I would expect for that to happen, reasons I would expect that to happen tomorrow or Thursday, we get unemployment numbers, and the bulls are dying for unemployment to start ticking up. Now, one of the things that we got last week is a revision in the jobs data, I believe from July, some past in the summer, okay? Where we went down, they revised the jobs down from 1 million jobs created all the way down to 10,000. So in July now, it is revised that we only created 10,000 jobs in that month as opposed to the massive million. Now, in a normal market, that's not even that big of a deal. It would be glassed over, nothing, okay, whatever, you know. Especially because maybe most of those jobs were seasonal or for whatever reason. Most people would just ignore it, especially because current job data would be more relevant than that job data. But with that being said, we need what the bulls need to. If the bulls are going for the pivot thesis still, if they're still bucking for it, and if you ask the bond market is still bucking for the bull thesis, or the bear. They're still bucking for the sort of bull thesis of the Fed pivot. The Fed's not going to be able to hold their interest rates. They're not going to be able to do it. The bond market is trying to signal that. They're still suppressing the yields. You can see that back over here, and so that's all kind of there. So the bond market is still calling BS on Powell. The stock market has at least conceded something, okay? They have conceded a little bit as far as what is realistic as far as like the Fed, when they're going to finish tightening. You know, they're definitely pricing in the interest rate hikes. All right, so really to what I think that your thesis needs to be if you're a bull is either A, you need stuff that's going to point you towards the soft landing. If you don't see the soft landing, if that's not the thesis, you need to get out. Because let it recess, let it crash, come in, buy the bottom then. Other than that, you have only the soft landing. A Fed pivot is not healthy in any way, shape, or form. But for the soft landing, you still need a rise in unemployment. You still need less jobs. You still need less spending. You still have to have earnings coming down. Now, if you do that and there's not like a wave of foreclosures and businesses closing and right, if there's not panic in the streets around that, you do have a recipe for a soft landing and at the very worst, probably a very shallow recession, one that's, you know, what they call an inventory-based recession. So coming into this week, we have that correction from back then. Pair that with the possibility of starting to see some of the seasonal labor move away. Not quite yet, it's a little early for that. Probably not going to see that till next week or the second or third week of January. And this is really, and which again, if it's small enough but big enough at the same time, you do have grounds for the potential of a soft landing going into 2023. Where you're at, I think you're at is I think that number, that unemployment number is going to come in heavy and hard and fast. I think it's personally going to hit like a sledgehammer, and then you will get your capitulation move. Second, third week of January, as we get a little closer to that, I will have a more detailed plan as to how to possibly trade this. Again, it is difficult. Trading for capitulation is mostly gambling, so it's not really, it's not trading, okay? Trading needs to be something you can repeat every day. I'm sorry, you can't get capitulation every day, okay? It's just not gonna happen. If that's what you're living for, really, if that's why you're in the market, is because you wanna be the next Michael Burry, just quit, you know, leave. Because nobody needs that. All right, so going through the rigmarole again, higher high, lower low. I hope to God this isn't our lower high. I really hope that, because there's no money left in this, right? I mean, you can do the level to level thing back to 348, but there's no money left. So I really want a nice big bump, right? I want to get back to this mean. I would even, if this thing will come out overbought or oversold, I would love to catch that ride up there and write it down. That's what I would love to do. We shall see. Again, I don't think you're going to lose this. So, trend, no trend, okay? Overall, that really means no trade as far as this whole thing goes. Trade is done. You'll be waiting for it to make a lower high. Try and get short then, but that's where you are, and with seasonality. All right, so no trend, but your bias is to the short side. You're underneath the mean or the 18-day moving average, and you are you're oversold. You're definitely not embedded just yet. So you're really waiting here for this to either A, just embed itself down here, or B, to where you can catch a move to the upside, or look for a short position coming. Now, and again, you have to kind of keep an eye on it. If the seasonality comes, if CNBC starts banging the Santa Claus rally thing, maybe money's more easy to the long side. But even then, you're still looking at getting over that 18-day moving average before you can take that trade. So there you go. And even then, I don't even know how high we go. I mean, we can get a triple top up here at 410. Could be as much as this. I don't know. I know that I've heard rumors that the New York fund managers, money managers, they're supposed to get their bonuses if the S&P hits SPY hits 415. So 4,105 on the S&P. So anyway, that's kind of my 2 cents on the whole thing for today. If you know anything about wedges or symmetrical triangles, feel free to hit me up. I would love to have a conversation about that. Leave a comment below. Until then, Russell Journal, written, edited, hosted by me, Russel Liss. And we're produced by Social Media Shows. Executive producer is Maria Pereza. Check out Social Media Shows if you're interested in doing one of these type YouTube channels. They can help you out quite a bit. And until tomorrow, pretend I said some sort of catchphrase.